People have always wanted to make money without working too hard. Passive income, a path that many investors believe leads to financial freedom. While there are many means to achieve this, one of the best ways to do so is by investing in special stocks that pay you money regularly, like a little bonus. This is what we call dividends. But which stocks should you pick? Can you select just a few and let them do their thing? And most importantly, can this investment ensure that you are financially safe in the long run?
One of these guys at the Berkshire meeting from one of the foreign publications said, why do a couple of guys in a little place in Omaha do so much better than all these powerful minds in great institutions?
In this video, we'll be introducing you to the best 8 stocks that you can buy and keep forever, straight from Charlie Munger's portfolio. We'll also show you how you can put them together in a way that not only gives you money regularly, but also makes you richer over time. But before we get into all that, let's talk about a critical error that investors commonly make. They pay too much attention to the current dividend yield. Want to know why that's a bad idea? When you're looking for worthy stocks, it's not just about finding the ones that have been paying money for a long time. It's also about finding the ones where the dividends keep getting better. This makes the stocks juicier to new investors and provides more money as time goes by. That said, let's check out the best 8 stocks that you need to buy and hold right now.
It's the long-term investment that works best. If you invest the way people gamble in casinos, you're not going to do very well.
Our first of the top 8 picks of forever dividend stocks is POSCO Holdings, a firm Charlie Munger gladly bets on. Guys, this is a reason why MacroAxis says this stock is a must-buy. POSCO is a company that's into making steel products, and they do this through a few different parts of their business: steel, engineering, construction, and trading. As of September 2023, they've paid out dividends of $6.79 for each share over the past year. Now, when you look at the current stock price, which is $447.12, that gives you a dividend yield of 1.52%. They also pay out dividends 4 times a year, in April, June, August, and November. But here's the catch. They didn't give more money last year like they usually do. This might not make some people happy who want more money from their investment, and sometimes you have to be patient. Now, when you look at their payout ratio based on free cash flow, it's pretty high at 527.6%. That feels like a lot, right? But they're not very consistent with this, at least not yet. So, why should you think about investing in POSCO? Well, they dominate about 40% of the local market share in South Korea. They also sell a lot of steel to other countries in Asia. This means they'll probably keep making money for a long time, which is good for people who want to make money from their investments in the long term. And they do more than just steel. They also trade and build stuff. This is good because if one part of their business doesn't make money, they still have other ways to make it. These and many more reasons are why Charlie Munger still banks on it.
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock.
The next pick on our list is Jefferies Financial Group Incorporated, a company that does quite a lot of stuff with money. They help with things like buying and selling companies, lending money to businesses, trading stocks and bonds, and managing wealth for people. In 2021, they earned a lot of money, nearly $1.7 billion, from their work on net revenue of almost $8.2 billion. They also pay a dividend that is decent in all ramifications. Right now, the company has a dividend yield of about 3.4%. One may argue that it isn't as juicy as they would have hoped for, especially given that it was slightly lower than that last year. There are a lot of positives to take here, though. Jefferies has been increasing the amount they pay in dividends for about 10 years, at about 17% annually. Additionally, even per-share earnings have been increasing quite nicely in recent times. However, does it belong in your dividend portfolio? Granted, Jefferies may not be one of the big investment banks you would hear about, but make no mistake, The company is relentless and doing many things right now. Considering its size, market share position, and its earning results, this makes them a good choice for people who like dividends, and it's worth keeping an eye on them. Jefferies Financial Group ticks a lot of the boxes for us from a dividend perspective, and we think these characteristics should mark the company as deserving of further attention.
We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have.
Our next forever buy and hold option is Viatris, a pharmaceutical company that you need to keep your eyes on. Let's be honest, guys. Placing investments in companies that make generic drugs might not be as exciting as tech options. But if you want to make steady dividends with lower risks, it becomes a different ballgame. Viatris is a company that has been gaining a lot of attention recently, and there are a lot of reasons for that. Right off the bat, Viatris's drugs can generate a lot of money for a long time. You see, people often choose cheaper medicines, especially when they have to take them regularly for health reasons, and Viatris offers quality in that area. Some of Viatris's medications, like Lipitor, Zoloft, and Neurontin, are well known and are used for ongoing treatments. In 2022 alone, Viatris made over $2 billion in profit. Plus, since most people can't skip their medication, even during tough times, the company wouldn't be too affected by economic downturns. On top of that, Viatris pays a dividend that is almost too good to be true. Their dividend yield is 4.5%, which is higher than the market average. Although they haven't been on their own for very long, given they separated from Pfizer less than 3 years ago, they still have the potential to grow their dividends over time. Lastly, Viatris' stock wouldn't burn a hole in your pocket. One might even say it is cheap. You can buy it at a good price compared to a lot of options. Plus, if the company starts growing more in the future, the stock might become even more valuable, which is good for investors and everyone. It is a relatively high reward and low risk. Up next, we have Ares Capital, a finance company that makes loans to middle market businesses that usually make between $10 to $250 million in profit before taking out certain costs like taxes. The reason for this is that the usual banks prefer to loan to bigger companies. Middle businesses are ripe for the taking. Ares Capital is what you'd call a business development corporation. One reason why we fancy them a lot is that they share a lot of the money they make with shareholders, which is good for making steady income and dividends. As a matter of fact, ever since they began trading on the stock market 2 decades ago, did you know that they have been giving investors more income than the average alternatives? They pay a really big dividend at 9.8%, which is why many people who want income love it. However, it is crucial to know that investing in this company comes with its share of risks. Things like a bad economy, rising prices, and changing interest rates can affect the company. But thankfully, Ares Capital tries to be smart about these risks. First, they spread their money out across different types of businesses. So if one doesn't do well, it doesn't hurt them too much. Right now, they have a lot of money in software, financial services, healthcare, and a few other areas. Also, most of their investments are in loans where they would get their money back first if a company they lend it to goes bankrupt. This helps protect their money. Again, it's easy to see why Berkshire Hathaway has this in their portfolio.
Something that's intrinsically a very good business, meaning that an idiot could run it and it would do all right. And then we want that business, which an idiot could run successfully, to have a wonderful person in it running it.
There is a reason Charlie Munger's Berkshire Hathaway has a 9.6% stake in Ally Financial Incorporated. It's a digital bank that is good with auto loans. At first, they used to pay a small dividend, say 2% before the pandemic. But now, it's much higher, at 4.2%, which is quite decent, especially when compared to others. While they have been giving out dividends since 2016, it is important to note that they have been making it bigger, with an increase above 250%. While Ally has a good pay ratio of 28% as of the end of last year, there is still room for improvement. Most of the large banks have theirs around 30 to 40%. Not many people know this, but Ally benefited greatly from the shortage of computer chips for cars during COVID-19, which increased the demand for cars and thus their prices. The company made a lot of money by giving loans to people who needed cars during the pandemic. Additionally, the high interest rates by the Federal Reserve kept the loan yields of Ally at a sky-high level. Right now, they're a bit worried that their profits may go down because it's getting a bit more expensive to borrow money than before. They expect the skies to be blue once more in 2024. That said, Ally's dividend of nearly 4% seems safe as long as nothing bad happens in the economy. And even if it does have a recession, we don't think that will be a problem. The big question, however, is whether or not Ally's customers will have trouble paying back their loans. But overall, things look pretty good. Citigroup is a bank that hardly needs an introduction. It is one of the country's largest and has many employees and branches in others. Most of their money comes from helping businesses and managing investments, rather than regular banking like savings accounts. But get this, they have been giving money to people who own their stock for at least 10 years. Nevertheless, we know that the past doesn't guarantee the future, but even the latter seems good. They only use about 32% of their earnings to pay dividends, so they have enough left for other things. Speaking of dividends, Citigroup currently has a dividend yield of 4.3%, which is great enough to make any shareholder satisfied. In the future, they expect to make even more money, about 12.6% more in the next 3 years, with analysts estimating them paying out around 35% as dividends. Funny enough, Citigroup has been giving dividends for a long time and keeps doing it at a pretty steady rate. It's gone from 0.04 cents a year in 2013 to $2.04 recently. That means they've been increasing it by about 48% every year. For the last 5 years, their profits have increased by about 17% each year. This, along with the low payout of dividends, makes it look like they'll keep increasing their dividend payments. Overall, Citigroup seems like a good stock for people who want income. They have enough money to pay dividends, and they're making even more, so it's a good choice for income-focused investors.
We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in.
Next up is Kroger, a really old and well-grounded grocery store company in the U.S. They have a lot of employees and have been growing their dividend for a long time. Recently, their dividends were at $1.04 per year, which at that time was 10.6% more than last year. Like that wasn't enough, they have raised dividends 5 times in 5 years with an average increase of around 14.57% each year. They only use 25% of their earnings to pay dividends, which is good for the company. This year, they reportedly expect to make $4.49 per share in profit, which is 6.15% more than last year. They also expect to have around $2.5 billion to $2.7 billion in extra money after expenses this year. Guys, in the future, things are also looking up. While it's still speculative, analysts believe that they might have even more money. Maybe over $3.3 billion, which is a lot compared to what their stock is worth. Kroger is simply a top choice if you want a stock that grows its dividend and doesn't pay out all its profits. Yes, it faces some competition and pricing issues in the grocery market, but its financials remain healthy, supporting high dividend growth, debt reduction, and potential buybacks. Their partnership with Ocado and focus on online sales should help them grow even more. Plus, they've been increasing their dividend for 16 years in a row. How many top firms can boast that? In all, Kroger's value creation model and go-to-market strategy have yielded positive results, with solid growth in sales and margins. With a track record of 16 consecutive years of dividend hikes and a low payout ratio, KR's attractive valuation and potential for strong dividend growth make it an appealing dividend stock.
If I were investing money for some sovereign wealth fund or some pension fund, and a 30, 40, 50-year time horizon, I would buy Costco at the current price. I think it's that strong an enterprise and that admirable a place.
Coming in at number 1 is a firm that has had Munger's unwavering admiration, earning him the title of a total addict. But why does this warehouse-style retailer fascinate the billionaire investors so much? Well, let's dive right in. Costco is a big store where you can buy things in bulk, and its stock has done well, going up 130% in the last 5 years. They started paying dividends in 2004, and it's been increasing ever since. Right now, if you own 1 share of their stock, you'll get about $1.02 every 3 months, which is about 0.7% dividend yield. In the first 36 weeks of 2023, Costco paid out about $799 million in dividends. But compared to the money they made, which was about $4.1 billion, they only used 19% for dividends. While this means there's still a lot to be desired, it is worth adding that Costco shows no signs of slowing down. They didn't even have big problems like supply chain issues or high prices during the pandemic. People like going there because they have low prices and good stuff. Costco made more money in the last 5 years, and its stock did better than most others. They also have a special way of doing business, where you pay for a membership to shop there, making most people want to keep coming back. They had 69 million members as of May 7th, and most of them stayed loyal. Having members helps Costco make money consistently, which is good for investors and the company itself. But this is something to think about. The stock is far from cheap right now. One may say it is even expensive. Nevertheless, Charlie Munger's addiction to Costco shows how much he respects the company and tops our list of stocks you need to buy and hold.